This might be the most valuable trading video that you've come across. I've been trading for almost 2 years and have watched countless videos on trading strategies. I've noticed that throughout this time, it was never my strategy holding me back, but my psychological approach to the market. Every account that I've blown has been a result of getting tilted, overtrading, revenge trading, and over-risking. Trading is a long and lonely road. There is nobody to tell you when you're making bad decisions but yourself. If you're anything like me, you can probably recall nights that you sit at your desk with your face in the palm of your hand, screaming at yourself, praying for something to click, searching everywhere for a video that is going to make trading click, but it never does. You search everywhere for the secret, and you don't realize that the secret is you. You are your worst enemy, and you are your savior. There is a light at the end of the tunnel, but while you're learning, it feels like it's impossible to see. I want to help you understand that if you can master yourself, you can master the market. I've made a slideshow with some key things I've learnt throughout my trading journey that have helped me, but my goal is for you to come away from this with the motivation to study these topics yourself and to keep pushing. If you want this badly enough, you will get it. Psychology and strategy are two different things in my opinion. I think you have a strategy and then you have your psychology, and you need to pair these together in order to have any success in your trading. As much as I consider them separately, you have to integrate them together, and you have to journal, and you have to really understand, okay, what in this trade that I lost, was it because of my strategy or was it because of something I did with my psychology? That could be, yes, I took a loss, which would be strategy, but how much did I lose? Did I lose more than I wanted to? Am I upset by this loss? And if you are upset by this loss, then you could say that the psychology, the psychological components that you put into your trade failed you. And so it wasn't really the strategy that failed you, but it was your psychology. And I'll get a bit further into that because it gets a bit deeper. So firstly, I'm just going to go over a couple of the key components of a trading system or a trading strategy. So that would be determining your risk in either dollar value or point value per trade. So, you could say, I have a $100,000 account. I want to risk, $100 each trade, or I want to risk $500, or I want to risk $1,000. That part is up to you. But regardless of how much you risk, that is something that I would consider a part of your strategy, because it's a predetermined risk and you plan your strategy in order to, allow that amount of risk, I guess. Number of trades per session or per day, that's also a part of strategy. I think you should have that predetermined, how many trades you want to be taking a day, and how to know when, okay, I've already taken 3 trades today, and I haven't had any success, or even if you have had success, you have to have a certain amount where you decide, okay, I'm done for the day. Because after a certain amount of trades, you're going to have decision fatigue, you're going to have a lot of factors start to come in, you're going to start thinking emotionally, because let's say you came off of 3 wins in a row. Okay, you're going to be thinking, I'm going to take another trade because I just keep winning. I'm always right. Or you'll take 3 losses and you'll go, nah, I'm down so bad. Like I've lost so much today. I need to make this back. Take another one. So that's sort of a blend between psychology and strategy. But if you just predetermine how many trades you want to take per day, you can make that a mechanical part of your strategy. Another thing is strict trade entry rules. That's probably the most important part about your strategy, because that's actually what your strategy is. So, do you enter off of support and resistance, or do you enter off of liquidity sweeps, fair value gaps, order blocks, indicators? It doesn't matter. Whatever it is, your trade entry rules need to be strict and mechanical. And if you can make it mechanical, then it makes it a lot easier to perform that strategy over and over again and have consistent results with it. How will you manage your position? When to exit or scale? That's also something that you can predetermine. So you could say, when I get to a 1-to-1 risk to reward, so if I'm up, if I risked $400 and now I'm up $400, I might move my stop loss to break even, or I might take off 50%, or maybe you even get out at full. But that's something that you should have predetermined, and you should not have to be thinking in the moment, should I take some out here? You should try and predetermine that as best as you can. And then the last thing is identifying what your edge is in the market. And it's easy to say, yeah, I know what my edge is, this is my strategy, but really, like, what is your actual edge? Like, do you know from journaling and from past mistakes, do you know what actually needs to happen in order for you to have a higher likelihood of being right than being wrong? And so those are the sort of the key components of strategy, and that's what I think strategy is. Now we've got the key components of trading psychology, and you can probably tell already that the list is a whole lot longer. And the reason that the list is longer is because it's so much less of a mechanical thing. You can't really just place a blanket set of rules over this component of trading and expect that you're going to know exactly what to do every time. And that's what makes trading hard, is because there's so many of these factors that contribute to your success, which are just it's just difficult, to be honest. It's difficult. And also, the reason I'm making this video is not only to try and help people, but also to reflect on my own decision making and my own trading, because I've written all this out, but by no means do I follow this every time. I have over leveraged and over traded so many times, and revenge traded. It's not even funny. And so I'm almost making this video sorry, I'm freeballing this. I'm just going off the dome. But I'm making this for myself as well as for you guys. I want to help you and I want to help me. So anyway, key components of trading psychology: restraining yourself from entering when your rules, aka your strategy, aren't met. This is super important, because if you've been sitting watching the charts for maybe 2 hours and you still haven't seen your strategy and your rules play out, you might get really annoyed and you're like, I'm bored. I want to take a trade. I want to make money. I want to get rich. And then you might enter. And that happens a lot. And that's definitely a component of psychology. It's restraining yourself from entering when you know that you shouldn't. If you click that button and you know that you really shouldn't have clicked that button, regardless of whether you're in profit or in loss, you should just get out, because you know deep down that that's not what you should have done. And you in the moment, you don't want to admit that. You don't want to tell yourself that you shouldn't have done it, but you need to really think, am I meant to actually be in this position or not? Exiting, scaling your position where your predefined rules allow you to. So this is pretty similar to the strategy part, but you have to understand, am I exiting now because I'm afraid of losing these profits? Or am I exiting now because price has gone to a level where I thought it was going to go and I believe that it's going to actually reverse? Or are you just exiting because you're like, oh my God, is it going to hit my TP? Is it going to hit my TP? I don't know, and getting out. That's good sometimes, a bit of intuition, but most of the time you need to avoid doing that and stick to your predefined rules. Understanding what risk actually is. This is super important, and I feel like only up until recently I didn't really understand this. And that's what that means is, so for me, I risk about $400 to $500 a trade, depending on how much I'm in drawdown or things like that. But accepting the risk is a lot different to just the risk. And what I mean by that is, you can risk $400 on the trade and be like, okay, if I lose, I'll lose 400. But are you actually happy to lose 400, or is that going to upset you? That's super important. If a $400 loss is going to upset you, you need to lower that amount of risk to an amount where if you do lose, you're okay. And that was like key. That really helped me, because I realized that, a lot of the time if I risk 500, I'm going to make a lot of profit, but if I was to lose 500, I might be really upset about that, and I might be like, oh shit, I'm in heaps of drawdown. So understanding what you're actually risking and accepting that and being happy to lose that is super important. Prohibiting yourself from allowing a loss to affect your decision making. And this is a part of the performance process cycle, which is something that was written in a book that I read called Mastering the Mental Game of Trading by Stephen Goldstein. And it's super important. I'll get into that. I've got a slide for it. But prohibiting yourself from allowing a loss to affect your decision making. What does that actually mean? If you take a loss and straight away you're trying to jump back into the next trade, or you're looking for the next opportunity to make your money back from what you just lost, you are severely impacted, most likely, by that previous loss. You most likely really want to make that money back, and what you should do instead is just step away for a bit and then come back when you're actually ready to make good decisions again, and you're not acting off of emotion. So I'll get into that a little bit further on, but that one's super good. Avoiding burnout, that's a part of psychology. Sometimes you've just been trading every day for multiple weeks on end. Maybe it gets to the weekend, and a lot of the times it gets to like Saturday morning, and I'm like, damn, I can't trade for 2 days, because it's natural to want to make this happen and to make money fast. So avoiding burnout's really good. Just accepting when the weekend's there, thinking, hell yeah, it's the weekend. I get to do whatever I want now. I don't have to worry about trading for a little bit, and that'll help you sort of avoid getting burnt out. Effective journaling, that's super important. Writing everything down, making sure that you're not just writing about, what the trade you took was, why you took the trade, but also how you felt during the trade, how your emotions were during the trade, how that loss made you feel, or how that win made you feel. That's super important, because you'll start to realize that if you were super affected by a loss that you took, did you end up taking more losses after that as a result? And you'll see that from your journaling. Controlling your ego, that's a bit of a hard sort of thing to go into. It gets pretty deep, but there's definitely a lot of ego in trading, and you obviously are going to think that you're going to be right, but you got to understand that the market is random a lot of the time, and you just won't be right all of the time. Time of day, that's a part of psychology, I would say. A lot of people get to trade in the morning when they start fresh. That's like in the US Eastern time. That would be amazing. I trade in the middle of the night, and I think that actually holds me back a little bit, because I've been awake for so long. I start to get tired, start to make bad decisions, and my mental capital is drained. I get decision fatigue, and so yeah, I think if you can find a way to trade at a time where your mind is super ready and you're dialed in, then that's really good, but sometimes that's not really controllable. And also just understanding yourself. Understanding yourself kind of wraps everything up here, but just understanding why you're actually losing, understanding whether it was your strategy, whether you actually lost and you're happy with the way you lost because of, you followed all of your rules, or whether you took that loss because you shouldn't have entered in the first place. So there was a lot of points for psychology, and there wasn't many points for strategy, and that's why I think psychology outweighs strategy by a lot, and that's why I think it's something that you really need to put some actual effort into. And I know it seems like you can just find a really good strategy and then you don't have to worry about psychology, but psychology is always there. It's your mind. Your mind is your biggest enemy. This is, trading is you versus you, and it's really true. So what does this mean anyway? It means that you should be investing equally as much time into your mind and your psychological health as you do for your trading strategy and your system, if not even more. You should try and be reading books about trading psychology. You should be trying to watch YouTube videos. Just do anything you can to understand yourself, journaling, all of that. And it'll really help in the long run. So yeah, how can we do this? Read books about trading psychology, watch YouTube videos, journal, and just be honest with yourself. When you're journaling, you need to be honest with yourself. If you took a win, don't just rub it off like it was a good win if you knew that you shouldn't have entered and you shouldn't have had that win. If you took a loss and you followed your risk management strategy and you weren't upset with your loss, you should be writing that down, and just being honest with yourself about these things. So now I'm just going to get into a bit of books that I've read. So the first book I ever read about trading psychology was Trading in the Zone by Mark Douglas. This is a pretty well-known book in the trading community. A lot of people know about this, but I'm just going to cover it anyway because I think there's probably a lot of people that also haven't heard of it. And something super good that was in this book is the five fundamental truths of the market. The first one is anything can happen. What does that mean? Well, it means anything can happen. You could look at the market and flip a coin. It was heads. That means I'm going to long. You could put one contract in long and be right. Or you could put one contract in long and be wrong. Literally anything can happen. Number two, you don't need to know what is going to happen next in order to make money. That's also, that was like almost a light bulb moment for me because I was like, that's so true. Sometimes I win and I think, oh, I won because I knew exactly what was going to happen. That's not really true. You had an edge, so there was a good likelihood that it would happen, but you didn't know it was going to happen. And you don't need to know what's going to happen in order to either win or lose. 3, there is a random distribution between wins and losses for any given set of variables that define an edge. This is really, 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 really important because I actually just came off of 4 losses in a row. I haven't made a trade recap on the last 2, but I lost 4 trades in a row on my funded account, and I got within about $700 of blowing the account, and that was pretty stressful. I'm going to be honest. I was sort of like, oh, this sucks, but I had already set my risk parameters in a way where I was able to lose 4 trades in a row and be okay. If I was to lose any more than that, I probably would blow the account, but I also know statistically that usually I don't ever lose 4 trades in a row, right? But anyway, that just, what it means is there's a random distribution, right? So let's say you have a strategy and you back tested that and you followed that strategy with exactly the right rules every single time. What you could do 100 trades and be right 70 times and wrong 30 times. Then you could do another sample of 100 trades and be wrong 70 times and right 30 times. There's a random set of variables for every edge and every strategy in the market. An edge is nothing more than an indication of a higher probability of one thing happening over another. I don't think I really need to explain that very well or very much, but just think about it. An edge is nothing more than an indication of a higher probability of one thing happening over another. So that means if you lose, why are you beating yourself up about it? Why are you so upset? You had a higher probability of being right, but you were wrong. You just had an edge. You have an edge. You thought you were going to be right. You had reason to assume you were going to be right, but you were wrong because there's a random distribution of wins and losses. And then 5, every moment in the market is unique. And I think something good to explain that is if you see a setup, let's say you see a liquidity sweep, you see some sort of indication in the market that you think prices are going to go higher, you enter that trade and you made good profit. You took a really good trade. Then the next day, the exact same looking setup happens, but you're wrong. And you might be thinking, well, what's going on? My strategy doesn't work. But that's not true. It's just because every time that you see your strategy, it's different. It's different. It looks the same, but it's different. And you just need to understand that sometimes you're going to win, sometimes you're going to lose. And then there's the 7 principles of consistency. Number 1, I objectively identify my edges. Number 2, I predefine the risk of every trade, which I covered before. 3, I completely accept the risk, or I am willing to let go of that trade. That's super important. I sort of explained that as well, but if you enter and you decide, okay, I'm $200 down, if I actually do lose this trade, if it goes all the way to my stop loss, am I going to be upset? Am I going to be really pissed off? And if you are, you should just exit. Just exit the trade. And I say that like I'm really good at doing it. I'm not. Literally last night I took a loss and I was kind of tweaking. I was thinking, because this was the fourth trade and I ended up losing it. And I was really like, oh God, if I lose this, I might be in a bit of a tricky situation. I didn't close my position, but if I had of, it would have been a lot better. So if you decide that you've risked too much or you're not happy with what the potential outcome might be, just close the trade. I act on my edges without reservation or hesitation. That's super important. If you see your exact edge in the market, if you see your strategy right there, super clear, it's right there, and you're afraid to enter, then there's something wrong. Either you're risking too much, you already have taken a couple wins for the day and you should just go to bed. There's a couple things. But yeah, just if you're hesitating to enter, then there's probably something wrong. There's probably something that's there that you should be avoiding. I pay myself as the market makes money available to me. I continually monitor my susceptibility for making errors. I think that one, number 6, is super important, and I think journaling is the best way to go about that. Monitoring your errors, having consistent data backing up the reasons that you failed a lot of the time. And if you know the reasons that you failed, then it makes it a lot easier to avoid those errors. And number 7, I understand the absolute necessity of these principles of consistent success, and therefore I never violate them. That is way easier said than done, I'll be honest. It's just really hard to do that. If you are to never violate them, which you will, there'll be times where you do, but if you make it your goal to never violate your rules and to always do the right thing regardless of the outcome, you will be far more consistent. Anyway, that's about all for that one. Book number 2, Mastering the Mental Game of Trading by Stephen Goldstein. I said before about the performance process cycle and that I was going to come back to it, and this is what it is. So what it is, right, is basically you start here at the reset. Let's say you woke up in the morning, 2 hours before market open. You're feeling good. Maybe you're a little bit excited to trade. You're excited to make money, right? And then you during this phase until the market opens, you need to be in what he calls the being phase, where you're focusing on being calm, thinking about making sure that you follow your process how you know you need to, and that you could do anything in this phase really. You could meditate if you want. You could just have a coffee and sit with your dog, pat your dog. You could have a cigarette. You could have a vape. You could do whatever you want. But if you feel good, if you're relaxed and you're ready to go into the market, with a strong mind, then that's really all the being phase is. I will say, I read that book quite a while ago. There's a lot more to that being phase than what I said, and smoking a cigarette before market open is definitely not part of it. But it's just about staying calm, in my opinion, the way that I see it. And then there's the production phase, right? And this is all started by a trigger. So okay, I see the market's opened. I see we've taken out a level where I think we're going to reverse, right? That's where you need to enter the production phase. You need to hyper focus in on the market and look at it and think about it and think about, is my edge actually here, or am I just excited because there's potential that I'm going to enter the trade? You need to be writing down what your plan is, what you're going to do, and maybe checking off a checklist of, okay, well, this part of my strategy is now happened, this part has now happened, this part has now happened. And if those parts have happened, then you're allowed to act, okay? And acting is the performance phase, right? So you take action, you enter the trade, you've set your risk, you're in the trade. And this is the performance phase. And this part is super, super important because the performance phase is where all the emotions are, okay? You could be halfway through the performance phase. Let's say you're halfway to stop loss. You're starting to get angry. You're starting to get annoyed. You're starting to get emotional. And then you lose, okay? And you lost, and that's the outcome. Now, the outcome, whether it's a loss or a win, you need to go through the letting go phase. The letting go phase is probably just as important as the performance phase, because when you have realized, okay, I lost, you cannot skip the letting go phase and go straight to the reset phase. Because if you skip the letting go phase and go straight back to the reset phase, then you'll probably skip the reset phase and go straight to the trigger. Enter again, performance process cycle of death. Seriously, you need to, when you take a loss or a win, you need to have that time in between where you just reset, whether that's going out for a walk, listening to some music, looking away from the charts for a little bit, journaling your trade maybe, having a cigarette. It doesn't matter, but you need to let go. And that's really all the performance process cycle is, but I've been trying to implement that into my trading quite a lot. I've been trying to really reset after a trade plays out, and because I've realized that so often I take a loss and I just get annoyed, I get triggered, and I just try to find the next possible opportunity as fast as possible. I skip the letting go phase, I skip the being phase, and it just causes me to take another loss. And after you take another loss, you start skipping phases faster and faster and faster and faster, and that's how you blow accounts. That seriously is how you blow accounts. That's how you get caught up in the emotions, you get wrapped up. That's those moments where you're sitting at your desk, feeling like an absolute gambling addict, having no good reason to enter trades, and blowing your account and losing your money because of it, and hurting yourself, hurting your mental health, hurting literally everything, hurting all of the hours that you've spent learning and trying to be a good trader. You will hurt yourself. So you should always try and go through the letting go phase. And that's really all I have for today. I'll say again, I know I'm not an expert. I make so many mistakes. I haven't even passed a funded account yet, but I'm making this video for myself and for you guys. I'm making this to remind myself of what I need to be doing, and also to try and help you guys with some things that you could start implementing in your trading as well. So I don't want to come across like some know-it-all that knows everything. I know I don't know it all, but I'm just trying to help you. And if you disagree with some of the points that I made, that's completely fine. I understand that. But if you found any value from some of the points that I've made, let me know in the comments. I'd really appreciate it. I started a free Discord server. There's about 7 people in there at the minute, but I want to try and build that up, because trading is really lonely. You spend a lot of time on the charts just on your own, maybe listening to music, but you get bored and you don't have anyone to talk to about just what you're doing. It's not like a normal workplace where you get to chat to someone on your break or just talk to someone at work. So I would like to make a Discord. I want to make a Discord community where people can learn together and help each other. But yeah, that's really all I've got for today. I'll be trading tonight for the New York AM session, and I'm also going to make a trade recap at some point of those 4 losses that I took earlier, because I made some of that back. But yeah. Anyways, thanks for watching, guys. I appreciate it. See ya.